JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the months gone by. This would be followed by our view on the domestic debt markets, which could in turn impact the positioning of our schemes. US CPI eased to 3% in June 2023 from 4% in May 2023. On a sequential basis, the CPI moved up by 0.2% in June 2023, higher than 0.1% in May of 2023. There seems to be no visible trend of global inflation cooling down on a sequential basis, although there has been a decrease when compared with the inflation numbers 1 year ago. Further, goods inflation is moderating on lower commodity prices. However, services inflation remains elevated. Services less energy inflation in the US remains elevated at 6.2% as on June 2023. Core inflation remains sticky and substantially higher than the 2% target, keeping the central banks agile. The Federal Open Market Committee, or FOMC, hiked the federal funds rate by 25 basis points to a target range of 5.25 to 5.50%. The guidance with respect to future rate actions was tamed from being certain about future rate hikes as indicated in the June 2023 meeting to being cautious and highly data dependent. While most of the global central banks are either on a rate hike cycle or have maintained higher interest rates, China has continued to maintain an expansionary monetary policy with a view to spur investment and consumption. Due to lower economic activity, inflation in China has remained in check and below the central bank's target of 3%. Bank of Japan seems to be at the start of a slow shift away from decades of its ultra-loose monetary policy. On the domestic front, while year-on-year numbers are not worrying, sequential momentum in CPI show a continued uptick in the last 3 months, prompting worries about rise in inflation trajectory through the rest of the year. In the coming months, food inflation could see further spike, largely due to supply-side inflation. Bond yields hardened during the month, largely tracking the movement in US Treasury yields. The 10-year G-Sec traded in a band of 7.06 to 7.18% and closed at 7.17% in July 2023 as compared to 7.11% in June 2023. Liquidity conditions remained comfortable during July 2023, largely due to continued inflows in the banking system through the withdrawal of Rs 2,000 notes. Average systemic liquidity surplus stood at Rs 1.62 trillion in July 2023 as compared to Rs 1.28 trillion in June 2023. Credit growth inched higher to 20.2% as on July 14, 2023, highest level since September 2011. Credit growth was led by services, personal loans, agriculture and industry, in that order. Deposit growth stood at 13.2% as on July 14, 2023, with a marginal uptick over the previous month. The rate hike cycle in the US seems to be at a fag end, with inflation following a downward trajectory. The growth and employment numbers in the US are giving mixed signals, with no clear indications with respect to whether the economy is headed for a soft landing or a recession. US GDP is growing at decent pace, whereas PCE is running lower than expected. However, core inflation remains elevated. The NAHB housing market rose for a 7th month to 56 in July 2023, close to around mid-2022 levels, indicating lack of slowdown in a segment which is one of the largest employers. Recent bank results show lack of any spikes in NPA levels and credit growth is normalizing as well. So there seems to be no indication of transmission of banking crisis of March 2023 into a wider slowdown as of now. We are watchful of wages in the US as GDP continues to grow. Wages continue to grow, and if wages continue to grow, then inflation may come back. This makes a case for a scenario where global interest rates are kept higher for longer to gauge the impact on economy as well as to contain inflation. While US and India are staring at higher rates with no clear visibility with respect to rate cuts, it remains to be seen how other key global economies like Eurozone and UK take stance on monetary policy, where inflation has not moderated substantially. Another key aspect remains the continuous stimulus by China and persistent attempts by OPEC to reduce production, which may just indicate commodities have bottomed out and may continue its upward journey from here on. We remain watchful of risks resulting from Bank of Japan, which might decide to move towards a tighter monetary policy amid sharper currency depreciation. Domestic yields could see some volatility as inflation might surprise on the upside in the near term, largely due to elevated food inflation. Whether these volatile food items get translated into general uptick in inflation would be a key worry from RBI's perspective. However, we do not expect any rate action from the RBI as any upside move in inflation is likely to be transitory. The trajectory of domestic interest rates would be mainly dependent on global developments coupled with demand supply and liquid dynamics locally.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.